When it comes to Tesla, insights of groundbreaking report suggest that the company's stock price could skyrocket to an astounding $1,000 per share by 2026, leaving its current value of roughly $200 far behind. The forecast for the next 5 years indicates a remarkable opportunity in autonomous driving that could reach trillions of dollars, even a small slice of this enormous pie. Are you planning to retire in the coming years? If so, do you think that what you have is enough to maintain your lifestyle? If your answer is yes, then good for you. If you want more, though, I suggest you keep watching before we begin. Market would have a big influence. How much would you be ready to risk on this automotive powerhouse? If you were to invest in Tesla shares right now, given that the company is portraying itself as the frontrunner, with more groundbreaking innovations to come, Tesla has emerged as a leader in the electric vehicle market. With these lofty objectives, the firm not only wants to produce outstanding products, but also makes an effort to keep costs as low as possible. By sales, it looks like Tesla will overtake all other automakers in the globe in 2026 or 2027. Tesla tomorrow. Taking into account Tesla's current prices and prospects, it could be wise for investors to improve their investment rating from a hold to a more positive bond. Let's investigate why. Despite the introduction of several competitors, Tesla has been able to maintain a significant market share. Unlike some of its competitors that struggle with profitability, Tesla has maintained its position over the years, and it is probable that their dominance will only grow as the sector expands further. Tesla has established itself as a very successful company, making its shares a desirable long-term investment. Tesla has completely revolutionized what it means to be an automaker. In addition to making electric cars more widely known, Tesla has transformed sales tactics by going direct to consumer instead of through traditional dealerships. The company has also abandoned traditional advertising in favor of gaining media attention and utilizing word-of-mouth marketing. With its premium brand image, Tesla has soared to new heights thanks to these audacious bets that have paid off handsomely. Tesla continuously creates strong consumer demand while cutting costs that traditional automakers ignore. Industry analysts believe that the average price goal for Tesla stock over the next 12 months will be approximately $218.95 per share, with some estimates reaching as high as $403.33, while others sink to a measly 33.33. Let's focus on the financial aspect of things. In North America, the average monthly expense per person, when additional extraneous costs like travel and healthcare are taken into consideration, comes to about $3,000. This amount rounds up to about $5,000 per month, which is $60,000 annually. Therefore, you would need about $2 million to live comfortably for the next 33 years. What does this mean for your retirement and the possibility of tests to share? Taking into account Tesla's current valuation, it appears likely that this stock could be a wise investment in the years to come. For a number of reasons, investors should watch out for two possible catalysts that might have a significant impact on Tesla in the near future. Tesla is projected to continue on its upward trend. First, the remarkable delivery numbers point to a clear signal of stronger than expected vehicle demand. Furthermore, Tesla's profitability is outpacing forecasts at the gross margin level. These encouraging developments are good news for the company's long-term financial outlook. In the short term, one of the main reasons for Tesla's optimistic outlook is the possibility of a sharp rise in the rate at which electric vehicles are adopted. At the moment, market projections for this rate in the U.S. by 2030 range from the mid-40s to the mid-50s percentage points. According to a study analysis by Needham and Firms, manufacturers might have far greater targets in mind. The survey states that most automakers are aiming for by 2030 or 2035, 100% of their sales will be allocated to electric vehicles. This suggests that analysts may have been unduly conservative in their estimations, allowing for favorable shocks that would eventually benefit Tesla and the market. Future growth for Tesla won't only depend on rising auto sales. The firm has seen notable revenue growth from its services and other businesses over the years, and there's still plenty of space for growth in other areas as well. There is significant potential for Tesla's supercharging revenue. According to a Goldman Sachs research paper, the additional revenue opportunity may be somewhere between $1 and $3 billion in the next few years if Tesla allows all EV drivers to use its supercharger network. Future profits per share, EPS, growth for Tesla is anticipated to be rapid, possibly even surpassing its revenue growth. The possibility of a capital return to shareholders and operational leverage are the main drivers of this optimistic forecast. The potential for Tesla to gain from favorable operational in 2022 leverage is clearly seen in the third quarter. Even though operating expenditures increased by only 2.3% compared to the company's noteworthy 55.9% growth in revenue, Tesla demonstrated its capacity to turn a profit, which highlights how the company's finances gain from successful operations. Leverage and share repurchases can further enhance the company's potential for future profits per share growth. During Tesla's Q3 2022 earnings call, the company highlighted the ability to repurchase up to $5.10 billion in shares, even in the event of a negative outcome. As a result of selling 491,000 cars in the U.S., Tesla has been creating ripples in the market. Recently, Tesla overtook BMW to become the leader in luxury sales in the United States. Held the top spot for the previous 3 years. But in 2022, they only sold 332,388 cars in the U.S., dropping them to second place. In 2022, Lexus sold a total of 258,704 vehicles, while Mercedes-Benz placed in third place with 286,764 sales. Looking ahead, Tesla not only surpasses these well-known brands, but also makes history by being the first American manufacturer to be ranked number 1 in 25 years. Tesla is predicted to generate revenues of $20.69 billion in 2023, a significant increase in unit sales in the U.S. By 2027, the company is expected to have grown at a pace of 3.97% per year, with a predicted market volume of $19 billion. Morgan Stanley analysts see Tesla's stock's current upward trend as a desirable entry option. The company had earlier changed its price target, which was $330 per share to $250. This change was designed to take into consideration the possibility that Tesla would find it difficult to meet future demand for EVs and a recent development. Adam Jones, a Morgan Stanley analyst, maintained his overweight rating for Tesla shares. According to Jones, self-funded companies with proven scale and efficiency have the ability to succeed in the EV market despite its competitive nature. Tesla-like supply networks stand a decent chance of succeeding in this market. Given that Tesla has grown by an astounding 4 times in just 4 years, with expected revenue of $300 billion, Morgan Stanley predicts that by late 2026, Tesla would surpass GM's market share in new car sales revenue. By 2030, it will have surpassed both Ford and GM together. Despite the recent underperformance of Tesla shares, Morgan Stanley acknowledges that Ford and GM can still remain relevant in the EV ecosystem by cutting back on their profits. However, they also caution about a potential risk to these traditional automakers, including rising labor and material costs and the execution of scaling future EV model launches. The extended prospects are still favorable. Glancing forward based on its forecast compound annual growth rate for key financial measures, Tesla is expected to maintain its rapid growth over the next 5 years. Additionally, following a spike in the company's stock price earlier this year, Tesla's valuations have become more reasonable. Despite investor concerns regarding the current market conditions, Tesla's ability to maintain profitable vehicle sales, and the challenging economic climate, the general consensus is that Tesla will continue to be a rapidly expanding business. So, the question of whether to buy Tesla shares remains. The predicted compound annual growth rate for its top-line sales, net profit, and free cash flow further supports this notion. A prudent retirement option. Please share your opinions here, along with your assessment of Tesla. If you'd like to see the most recent information about Tesla, click the next video that appears on your screen. We'll see you there.